Hello and welcome. In this lecture video, I'll be talking about investing activities and financing activities. These are two of the other sections of the statement of cash flows. Remember, the first section is the operating activities, and we talked about that in the first lecture video. Now I'll talk about investing activities, financing activities, non-cash investing and financing activities, the format of the statement of cash flows and the general steps for preparing the statement of cash flows, and then we'll conclude by doing some quick check problems, okay? All right, so as we talked about in the first lecture video, the operating activities section of the statement of cash flows relates to those transactions that typically determine net income. When we're talking about investing activities, we're talking about those activities that affect long-term assets. So plant, property, and equipment. Focus on plant, property, and equipment. Okay? Those transactions that focus on long-term assets, plant, property, and equipment, for example. Okay? We can also, not just plant, property, and equipment, but although a lot of our examples will revolve around that, but it could also be with the purchase and sale of short-term investments, and then also securities of other entities other than cash equivalents and trading securities. So this right over here, trading securities and buying short-term investments, that relates to Chapter 15. And again, as I talk about in Chapter 15 lecture videos, which I've saved Chapter 15 for the end of the semester. You can certainly watch it ahead of time, but in your course pack, it's towards the end of the semester just because I want to come back to some debits and credits. So I save it there. But anyways, Chapter 15 is referring to this, and it's talking about purchasing investments, stock, for example, in another company. Maybe you purchase stock in a key supplier or key customer. The purchase and sale of those investments, stock in a key supplier or key customer, would be classified as investing activities. Okay? Also, continuing on, lending and collecting money for notes receivable would also be considered investing activities. Now, when we talk about notes receivable, we have to clarify that a little bit. Now, this is very detailed, very granular. When we get to the test, I'm not going to be at this level right over here, but I still want you to be exposed to it, but just know that these bullets will not be on your test, okay? We talk about notes receivable, any proceeds from notes receivable that come from sales to customers. That's operating activities because sales to customers are operating activities. So if you were to make a sale to a customer, as we talked about back in Accounting 101, and rather than debiting accounts receivable, you debit notes receivable, that's operating activities, okay? But if it's from a loan, not sales, but you loan money to another organization, the cash receipts from collecting on the note, that is investing. That's on the note principal, investing, okay? The interest revenue on that note would be operating. All right. Some examples of investing cash inflows, cash proceeds from selling long-term productive assets. So that's where I was talking about a minute ago, talking about plant, property, and equipment. Okay. Selling investments, stock in another organization. Collecting on the principal, not the interest, but the principal on notes receivables. Okay, notes receivables that originated from loans, not from sales. Okay. Examples of cash outflows, transactions that affect purchasing long-term productive assets, such as plant, property, and equipment. That's why I talked about that there. That's why I focused on that, just because a lot of our examples in this chapter will focus on investing activities that relate to plant, property, and equipment. Okay. Purchasing stock in another company, that's investing. Okay. If we sold it, that's cash inflow. If we buy stock in another company, that's a cash outflow because we're paying cash. Or purchasing bonds, debt, bonds of another company, that's also a cash outflow. Okay? So when we talk about financing activities, we're talking about those transactions that influence long-term liabilities and also equity account. Okay? So that means it relates to those transactions between the company and its owners, which is equity, and then creditors, liability. So whereas investing is looking at those transactions that affect long-term assets, such as plant, property, and equipment, financing is looking at those transactions that affect long-term liabilities, okay, such as bonds and equity accounts. Okay, so some examples, some financing cash flows examples. If we look down here, we could say proceeds from both short-term and long-term borrowing. That'd be a cash inflow. So if we extended credit, okay, we extended credit, all right, we could have our short-term and long-term borrowing right over there. Issuing its own equity securities, so issuing stock, issuing bonds and notes, so issuing bonds and notes payable, okay, issuing short-term and long-term liabilities, notes payable, and then also contributions by owners, and that's what I was saying up here, issuing stock. So this affects equity. These are long-term liabilities, equity, and then long-term liabilities. Okay. In terms of financing cash outflows, paying dividends. Now, dividends received, that's operating, because that would be related to dividend revenue, which would show up on the income statement. Paying dividends, though, does not show up on the income statement. Okay? Paying dividends does not show up on the income statement. It's classified as a cash outflow under the financing activities section of the statement of cash flows. Purchasing treasury stock. Remember, treasury stock is when a company purchases its own stock, okay, like stock buyback. Repayments of amounts borrowed. So if we had issued bonds, that's a cash inflow. When we pay back the par value at maturity, that's a cash outflow. Paying any owner withdrawals is another example of a financing cash outflow. In terms of non-cash investing and financing activities, there are some situations where investing and financing activity wouldn't affect cash inflows or cash outflows. So it doesn't affect any inflows or outflows, but it still needs to be disclosed per the full disclosure principle. Here's an example of what I mean. If we purchased long-term assets, so let's say we purchased a building. And we didn't put any cash down. So we financed the entire purchase of the building. Does it affect cash at all? Well, no, because cash didn't go down. Cash didn't go down. So what I'm saying over here, in this case, the company is financing the entire purchase of the asset. No cash flows occurred at all. No cash inflows or outflows occurred, but it still would need to be disclosed in a footnote. It would have to be disclosed in a footnote, but it could also be disclosed in a supplementary schedule. Okay? It would have to be disclosed per the full disclosure principle in a footnote or in a supplementary schedule to the statement of cash flows. Okay? So let's talk about the format of the statement of cash flows. Again, it has operating activities, investing activities, and financing activities, which is what we've been talking about in these first two lecture videos. So if we look at the format, we have cash flows from operating activities, and we list all the different activities that flow down through here. And then we say net cash provided, used by operating activities. So when it says this, provided versus used, Provided means cash inflows exceed cash outflows. So cash inflows exceed outflows. Used is the opposite. Outflows greater than inflows. And that's the same with investing and financing. So what we do is we show all of our cash flows that would be classified as operating activities and list all those down. And then here we say, all right, cash flow provided, which means inflows more than outflows, or cash flows used in total, outflows more than inflows. And we show the total here for operating activities. Then we do the same thing over here for investing activities. We show, well, we purchased land and then we sold a building, for example. And then we say, was inflows greater than outflows? We say net cash provided. Outflows greater than inflows? We say net cash used, and we list the total. Then we do the same thing down here for financing activities. We issued some bonds, which would be cash inflow. We pay dividends, cash outflow. And then we say, we subtract the inflows from the outflows. Is inflows are greater than outflows? We say provided. Outflows greater than inflows? We say used. And then we add up the total cash used or provided by operating, total cash used or provided by investing, total cash used or provided by financing. We get a total, and then we look at what was our cash balance from the balance sheet at the beginning of the period. Okay, beginning of the period is the same as prior period's year end. And then we add that to our net increase in cash, which is this plus this plus this. And then we make sure that equals our cash at the end of the accounting period. So for example, let's say this is 20, and let's say this is 30, and let's say this is 50. Okay. And so what we have over here is we have 100 increase in net cash, okay? And then what we have over here is we have our prior period cash balance was 100, and then what we would say is 100 plus 100 gives us 200 over here, which is current period year end. And so we would make sure that by taking our difference in cash, which you can see here's year end, and then here's beginning, it's a $100 difference, and does that reconcile to adding all those up? If it does, we're good to go. If it doesn't, we did something wrong and we need to go back and double check our work. Okay? In terms of the steps for preparing our statement of cash flows, we'll first compute our net increase or decrease in cash by looking at comparative balance sheets, cash at prior period end, and cash current period year end. We will do our operating activities. We will do our investing, we'll do our financing, and then we'll prove by adding our net cash provided or used in total, right, to our prior period year end and make sure that equals our current. And that is our reconciliation. Okay. So now in the next 2 pages, I'm skipping ahead a little bit in your course pack. So I'm looking at these quick check problems that go on to these 2 pages right over here. So what I want you to do is to pause the lecture video and do these quick check problems, and then we'll come back and check it. Hello and welcome back. So let's see how you did. So the first one, a cash equivalent, is E, all of these, which is straight out of the course pack talking about the definition of a cash equivalent. Okay. Activities that involve the production or purchase of merchandise and the sale of goods and expenditures administering the business, those are operating activities. Those activities are transactions that revolve around the generation of net income. Okay. We look at number 69. If a company borrows money from a bank, the interest paid is interest expense, which shows up on the income statement. That'd be classified as operating activities. The purchase of long-term assets by issuing a note payable for the entire amount would be either disclosed in the footnote or schedule of non-cash, which I was saying in the notes, the supplementary schedule of non-cash financing and investing activities. And then finally, the last one, the statement of cash flows, helps us to determine all of these. Okay, thank you.